I'm going to start out today just giving a very short overview on VicTech and our affiliated Vic Investor Network. Probably just spend 5 or 6 minutes on that just as background. And then the main topic for today is tax considerations for investing in venture capital stage life science companies. Please feel free to submit your questions at any time during the presentation using the Zoom Q&A function. We'll circle back around at the end and answer all questions submitted, but please submit at any time during the presentation. So my name is Calvin Goforth. I'm co-manager of the Vic Investor Network as well as CEO of VicTech. My colleague Michael Erdinger is co-manager of the network and is executive vice president in Vic. Michael will be leading the Q&A session at the end. Both Michael and I have many decades of experience in startup company development in various roles, including founder, executive board member, and investor. We've each raised tens of millions of dollars of capital along the way and brought products from technologies at the earliest stage all the way through commercialization and eventual company exit. Both our bios and the full VicTech team bios are available at victech.com/team if you'd like more information. So first of all, let's say, what is VicTech? We're a venture studio. Our business is to form and build companies based on promising medtech and biotech innovation. We source these technologies from top research institutions around the world, primarily from universities, but other research institutions, including federal labs as well. We have an internal team that we call our Opportunity Assessment Team. It comprises our managing directors and other Vic executives and scientists and engineers, as well as our Vic fellows who are scientists and MDs and life science background people who every week we're bringing new technologies that have been identified as potential technologies of interest, as potential intellectual property foundations for new companies that we might form. We have a very rigorous assessment and due diligence process on these technologies. Those with the highest potential, highest upside relative to the risk, highest impact, we will exclusively license in the new company that VicTech forms. So as a venture studio model, we're the largest founding shareholder of each new company in our portfolio. The inventors are invited in as co-founders and technical advisors. And we put in place the initial executive team, the initial product development team, and Vic Investor Network co-invest the founding investment up to $500,000 needed to launch each company. Of course, $500,000 is kind of a drop in the bucket compared to the total capital needs for these companies. We participate in the follow-on rounds as well, again, co-investing with the Vic Investor Network, but we also bring a large network of investors to review these opportunities and invest in our portfolio. We are, as I said, life science focused. That includes medical devices, therapeutics, and diagnostics. It also includes related areas like analytical instrumentation and bioprocessing materials. And our mission is to bring world-changing medical innovation to market. The Vic Investor Network offers its members high impact, high return opportunities, investment opportunities in venture capital stage companies. There's been over 50 investments placed since the inception of the network in 2013. Our members are mostly high net worth individuals, but recently we had our first strategic partner, a large life science company, join and take some slots in the network, which we were happy about. Across all investments made to date, including those both with realized exits and those whose current value is based on the last investment round share price, but across all investments made to date, there's an outstanding 38% IRR. The network is open only to accredited investors. If you're not familiar with that, that basically boils down to an individual whose salary is $200K or more per year, or jointly with spouse $300K per year, or who has $1 million net worth individually or jointly with spouse. There is a $30,000 minimum investment commitment to join the network. However, those investments can be placed in as little as $5,000 increments, which allows you to diversify your investments across a number of companies. There's no membership fees, there's no management fees, there's no carried interest. 100% of the investor's investment gets placed into the invested company on the same terms alongside VIC's investment. VIC pays the cost of maintaining the network. So nothing is extracted at all from the investor's investments. Each investment round is placed into a separate holding company. That does a couple things. It first of all, it keeps the cap tables of the invested companies clean. Future investors, larger investors, typically frown on there being a lot of small $5,000 level investors, for example. So it keeps the cap tables clean. It also aggregates voting rights, which helps protect all the members' interests throughout the life cycle of the investment, with VIC there as the largest founding shareholder and largest founding investor, investing on the same terms and with large voice in the company. It's an important differentiator for VIC Investor Network members. There's 3 levels of diversification possible. First, by sector, so therapeutics, devices, diagnostics, and related areas. Second, by stage of development, anything from the earliest founding investment to late stage investments and everything in between. And third, by what I mentioned earlier, given the low minimum investment of $5,000, you can spread your investment commitment across a number of companies to get 3 levels of diversification. Okay, with that very quick introduction to VIC and the VIC Investor Network, hopefully gives you some background where we're coming from. Let's move on to the main topic today, which is tax considerations for investing in venture capital stage life science companies. So our topics will be, first of all, just a little bit of background on life science startup investing in general, startup entity structure, the specific tax considerations for these type of investments, what's known as a qualified small business stock, 2 very important internal revenue code sections, 1202 capital gains exclusion and 1045 gain rollovers. And then I'll go into just a few examples and concluding remarks. I would like to mention explicitly, I am not a tax expert, and I'm not here today offering you specific tax advice. Rather, what I'm doing is, as both an individual investor investing in these companies and as an investment decision maker in VIC Tech investing in these companies, I'm wanting to share with you my understanding and experience on how to think about some of these things as an investor. For specific tax advice, you should definitely seek out an actual tax expert. All right, so let's just talk about a little bit about life science startup investing in general. First of all, why participate in life science company startup investing? I would say one of the major reasons is medical innovation is really experiencing astounding and unprecedented growth due to major advances in underlying technologies such as artificial intelligence and machine learning, gene sequencing and gene editing, hugely more powerful underlying analytical tools, many more that are driving this unprecedented growth in medical innovation. Of course, that provides a lot of investor opportunity. There's also an extremely large R&D investment in university life science research in this country. The federal government spends tens of billions of dollars in university life science research, and many tens of billions of dollars more in areas that have direct applications to life science research. And from these investments, there's many technologies created each year that have the potential to be the intellectual property foundation for high impact and high return opportunity companies. Not surprisingly, for the life science space, there are relatively long timelines, so you do have to consider that. But the opportunities for very high multiple return investments are substantial. So what should you expect for returns? It really varies widely by specific investment group, by investment group type, whether it's a VC fund or a micro VC fund or an angel investment group. And then with each one of those categories, success rates vary tremendously. And it's really hard to get a lot of specific information on like, for example, for angel investment groups, what the norm is out there. So rather than, trying to, assert what that is based on, limited data available, I'll just again focus on what I do know, which is VIC Investor Network's IRR, which is 38%. And what does that translate to in terms of, return multiplier? Well, a 38% IRR held 3 years is a 2.6x multiple. 5 years is a 5x multiple. 10 years, it's a 25x multiple. So again, the opportunity for very substantial returns. But life science investing is a complicated space. There's a lot of capital needed. There's very complicated intellectual property landscapes. There's difficult to understand market adoption drivers that really need to be understood to assess how are you going to get this invention out and have doctors change their existing practices to adopt it, and many other considerations. So there's a couple of strategies you can take to protect your investment interest in investing in these type of opportunities. First, again, diversification, multiple smaller investments rather than a single large investment. So whether you're investing, $30,000 or $500,000, if you're able to spread that investment across multiple companies, that diversification will help mitigate risk. I think it's also having an experienced and trusted partner, especially in a complex area like life science, is really important. It's no matter how smart you are and how experienced you are, it's hard to know everything about everything. And having other people there that you're co-investing with, that are helping with all the due diligence and all the considerations is an important factor. Also, having co-investing with a partner who has enough voice in the company to protect your investment interests throughout the life cycle of investment is a very important part. Regarding startup entity structures, the 3 you're likely to see out there are limited liability companies, S corporations or C corporations. A limited liability company, in a limited liability company, the profits and losses are passed through to members without there being any corporate level taxes. An S corp is similar in that regard, in that the profits and losses are passed through like the LLC. The S corp does have some limitations that typically make it only suitable for lifestyle type businesses. First of all, there's only one class of stock and there's a 100 shareholder limit, but both the LLC and S corp are pass-through entities that pass the profits and losses through to the owners. C corp, on the other hand, the profits and losses are taxed at a corporate level. Now, I will say that a potential advantage of an LLC or an S corp is that when you're investing in startup companies that are either pre-revenue or not yet profitable, those early year losses can be passed through to the investors and therefore deducted, whereas in a C corp they can't be, because again, the C corp is taxed at the corporate level. Regardless of that, experienced investors almost always require their investments to be in C corps for growth type companies, rather than, not talking about lifestyle type companies or that kind of thing, but for growth type companies, usually require C corps. And there's a few reasons for that. One is that the pass-through taxes are a significant headache sometimes. They can delay tax returns as you're waiting for the K1s for the companies before you can file your own tax returns, and other complications. There's also C corporations have much better established legal precedents. That's particularly true for Delaware C corps, which is why all VicTech portfolio companies are established as Delaware C corps. And importantly, the taxes from startup investments are typically going to be in the form of capital gains, and that's a potential major significant tax advantage for C corps, which we'll get into here in just a minute. So first of all, what capital gains, if it's a long-term capital gain, which means that it's been held more than 1 year, capital gains taxes are presently up to 20%. It's a short-term capital gain, it's just taxed as ordinary income. But in addition to the capital gains, there's also a net investment income tax, which is a 3.8% tax on investment earnings. That again applies depending on your filing status and income level. So for single filer, if it applies if they're over 200K adjusted gross income, and it applies in addition to the capital gains taxes. So before we go into how the tax strategies, we need to define what companies are considered a qualified small business stock, or QSBS. First of all, it has to be an active domestic C corp. So an LLC or an S corp do not qualify as QSBS. The gross assets must not exceed $50 million. The issuer must issue the stock directly. So for example, you can't buy someone else's shares in some startup and then have those shares be considered qualified small business stock. You must have obtained the shares directly from the issuing company, or as part of a holding company for that purpose. Eligible firms include those in technology, retail, wholesale, and manufacturing. Ineligible sectors include hospitality, personnel services, financials, farming, and mining. For what VicTech's involved in, deep tech, life science, they're always going to be eligible for QSBS. QSBS qualifies for favorable treatment for capital gains if the investor and company meet specific requirements. And more specifically, Internal Revenue Code Section 1202 was enacted in 1993 to encourage investment in QSBS. And it allows certain QSBS stock to be completely excluded from federal capital gains. So eligible stockholders, shareholders include individuals, trusts, and estates, as well as partnerships that have been set up in a manner preserving the 1202 qualification. And it provides 100% gains exclusion for eligible stock acquired on or after September 28th, 2010. It also excludes the 3.8% net investment income tax. So effectively, it creates an up to 23.8% tax rate savings from federal income taxes. To use the IRC Section 1202 exclusion, the QSBS must be held for at least 5 years before selling. The holding period of stock begins on the date that the stock was issued. So if the stock was from a conversion of debt, like a convertible note, or the exercise of options or warrants, the holding period wouldn't begin until the conversion took place or the options or warrants were actually exercised, not from when the convertible notes were issued or the options were issued. So, if convertible notes certainly have their place in these type of investments, especially as bridge rounds to a larger round that's going to establish a fixed valuation, and the convertible notes go in at a discount to that future valuation. But a disadvantage of the convertible notes is that it won't start that time clock on the 5 years. There's a limit on the exclusion of either 10x the basis of the investment or $10 million, whichever is greater. And again, I'll go through some examples of that. Most states conform to Section 1202, meaning that most states, if you're eligible for the Section 1202 capital gains exclusion on the federal level, you're also eligible for exclusion of the state capital gains. But there are exceptions. For example, California and Alabama don't allow exclusion of gain, and some of the other state treatments vary to different degrees. The second IRC section that's important for all this is section 1045, which discusses rollover of gains. Specifically allows stockholders to reinvest on a pre-tax basis the proceeds from the sale of an original QSBS into one or more replacement QSBS. So that can be used by holders of QSBS who are selling before satisfying the 5-year holding period requirement, as an example. Also, if you have, for example, the sold stock for greater than the 10x basis and $10 million limit, you can reinvest any portion of the proceeds. So you can reinvest the portion that exceeds the $10 million gain exclusion cap. The deferral of the gain on the initial sale of the original QSBS applies whether or not the stockholder ultimately is able to claim the 1202 gain exclusion. So if you invested in a replacement QSBS, even if ultimately that doesn't meet all the requirements for the Section 1202 gain exclusion, at the very least you've deferred paying your taxes. When you do invest in a replacement QSBS, your tax basis is reduced by the amount of the deferred gain. And I'll give you an example of that later to make that more clear. Importantly, a stockholder's holding period for the replacement QSBS includes the holding period for the shares of the original QSBS. So to use the Section 1045, you must have held the original QSBS at least 6 months. You only have 60 days from when the stock is sold to perform the rollover. You also must make an election to reinvest the proceeds under Section 1045 on a timely filed tax return for the year in which the original QSBS was sold. And a corporation issuing replacement QSBS must satisfy Section 1202's active business requirements for a period of at least 6 months after issuing the replacement QSBS. So to take advantage of the rollover, the biggest challenge is typically going to be finding and investing in a replacement QSBS within 60 days. That's a pretty short time to both identify and perform due diligence on a new opportunity. It's certainly better to pay capital gains than to make a bad replacement investment. Oftentimes you might have an opportunity and looks like that's what you'd like to do, but if closing dates stretch out, as they often do, to negotiations with other investors or for any variety of reasons, that can be problematic for someone trying to make their investment as a replacement QSBS in the 60-day window. So that is another advantage of being involved in some sort of network like the VIN Investor Network, but others also where you've always got high quality investment opportunities open, with deals already deep dive due diligence already done, and typically then VIN members can have a choice from early to late stage replacement QSBS. We can also, as a large voice in each one of these companies, VIC itself can help ensure that the investment closes in the required 60-day window. So the Section 1045, is really helpful because it allows you to reinvest the proceeds to meet that 5-year holding requirement, or it allows you to reinvest the amounts above the gain exclusion cap so that they also ultimately have their gain excluded. So both really important points. So let's take a few simple hypothetical examples to kind of really make this more clear. Let's talk about early co, which is a hypothetical early stage qualified small business. And let's say investor A invests $100,000 in early co at $1 per share. 5 or more years later, early co sells at $7 per share, providing all the investors a return. In this case, investor A is going to have a $600K gain from the $700,000 share. That's less than the 10x basis. In other words, less than 10 times 100, less than $1 million, and it's less than $10 million total gain. So in this case, investor A gets 100% exclusion of gain from federal taxes. Now let's look at a larger investor, investor B, investing in the same early co, but investor B puts in $2 million at $1 per share. Therefore, they have a $12 million gain from sale at $7 per share. That's more than the $10 million capital gains exclusion limit, but it's still less than 10x basis. So just like investor A, investor B has 100% exclusion of the gain from federal taxes. So and they also have the exclusion from the net investment income tax 3.8. So at an effective federal tax rate of 23.8%, and as an example, a state tax of 4%, the IRC 1202 is providing investor B a $2.9 million tax savings on their $12 million gain. So very consequential numbers. Second hypothetical example, let's call this investment in midco, a mid-stage QSBS. Whoops. Investor A again places investment at $1 per share. Midco sells 4 years later at $7 per share. That's a $600K gain, but it would be fully taxable since the investment was held less than 5 years. To avoid or defer the taxation, though, they can roll it over into a replacement QSBS. Investor B is going to be in the same boat. They've got a $12 million gain, fully taxable. But again, they can roll it over into one or more replacement QSBS. Third example is, let's look at investment in so-called home run co, also an early stage QSBS, but one that has particularly high returns. Investor A invests 100K to $1 per share, sells 5 or more years later at $15 per share. So they get a $1.4 million gain on their original 100K investment. That's more than the 10x basis limit, but it's less than the $10 million total gain exclusion cap. So investor A has 100% exclusion of gain. Investor B investing in the same home run co, $2 million investment, $1 per share. So it's a $28 million gain from sale at $15 per share. That's more than both the 10x basis and more than the $10 million total gain exclusion cap. So the investor B would have 100% exclusion of gain for $10 million of this $28 million gain, but the remaining $18 million would be taxable unless they roll it over into one or more replacement QSBS. Note that, if you remember what I said earlier, that the basis in the replacement QSBS is reduced by the amount of the deferred gain. In this case, since the amount of deferred gain is greater than the original investment, the basis in the replacement QSBS is 0. But there's a new gain exclusion cap of $10 million. So as long as you keep your replacement QSBS further gain below $10 million, you can still exclude the capital gains taxes. So those are meant just kind of illustrate how they work in practice. Kind of in conclusion, I do believe investing in life science startup companies offer exceptional opportunities. Having due diligence and partners is important. Having co-investors in the deal with strong voice in the company can protect your interests. IRC 12 and 2 and 1045 offer investors very attractive tax advantages. But again, having an investment partner like VicTech and Vic Investor Network can be advantageous in being able to take advantage of some of these tax benefits. And with that, I'm going to stop sharing my screen, and Michael is going to lead the Q&A. And anyone that still has questions, please go ahead and submit them now. Michael?
Yeah, the first question we have, Calvin, is can you invest?
Oops, I'm sorry, Michael. I've had a little hearing issue. Okay, I should be able to hear you now.
All right, can you hear me?
Yes.
The first question we have from an attendee is, can you invest excess gain in a company that you start yourself and have it qualify as a rollover?
Yes, you can, but there are some rules around that. So you would definitely want to be consulting with a tax expert. For example, you couldn't just take your gain above the amount that was excluded and create a little dummy LLC and hold it there and then later distribute it to yourself. The assets that are being invested have to be being actively used by the new company. So you can do that, but there are rules around it that you would have to be aware of.
The second question we have is, how long do you have to hold the investment in a replacement QSBS, qualified small business stock, if you are rolling over the portion of a gain in excess of $10 million?
Yes, I'm assuming that means you're rolling over the gain in excess of $10 million, and you're doing so solely for the purpose of the gain exclusion cap, but you have already met the 5-year requirement. In that case, and I'm not 100% sure on this, but I believe that you only have to hold it as in the replacement QSBS, which has to be an active 6 months. So you can you can potentially get that new gains exclusion pretty quickly, but that's a more complicated area that would you definitely want to discuss with your tax advisors.
All right, thank you. That is it for today's questions.
All right. Well, I hope this has been helpful. Appreciate everyone's involvement today, and if you have any questions, don't hesitate to reach out to me. Calvin.goforth@victech.com if you have any follow-on questions. But thank you for joining today.